Nvidia earnings today, 30 minutes until the start of trading. I'm Matt Miller.
And I'm Dani Berger. Bloomberg Open Interest starts right now.
Markets face a critical earnings test. Nvidia, the world's most valuable country, reports results with investors wary of AI spending.
And Wall Street executives ahead of that urging caution. Goldman's John Waldron saying that markets are primed for further declines.
And a cautious consumer. Retail results this morning signal that shoppers are turning to cheaper options as the economy shows signs of stress.
Matt, it's the one to watch today. You said it. It's Nvidia earnings, especially given this thing has fallen 12.5% from its peak in October. This morning, shares are moving higher, but again, we've had back-to-back consecutive declines for Nvidia, 1.8%. And it's the direction of the stock market. Sentiment, it will all hinge on what they report this afternoon. Options, Matt, are implying a 7% move in either direction. That on its own would add or erase $300 billion in market cap, which I think is like Oracle's market cap. So that could be a very large swing.
And speaking of, by the way, Oracle has made a complete round trip this year. It was a huge gainer, and now we're back to where we started. Target is the latest retailer to narrow its profit forecast as consumers get picky. Target cited discounts and softer demand for the revision. You can see Target shares down 3.5% in the pre-market.
Well, let's start with Nvidia, the story of the day. Joining us around the desk is Bloomberg Tech co-host Caroline Hyde. Caroline, how different is the setup for this Nvidia earnings, just given the fact that it's fallen to the degree it has, bringing down the AI trade with it?
What's interesting is even when Nvidia tends to beat, and it has beaten 12 straight times in terms of revenue, it tends to fall anyway. A lot of the time, a lot of optimism is baked into Nvidia's numbers on the earnings, and on the actual day after, they tend to sink, and then it rallies on some other types of news, like the GTC event that Jensen Huang had, where he articulated that he's got line of sight on $500 billion of revenue in just the next fiscal year. And so here we have yet another company that not only is riding on its own fundamentals, but is going to be a signal for the entirety of the market. Is capital expenditure going to be solid? How much can he answer questions on whether indeed, yes, CapEx is set to rise some 30% to the end of this year for the main key players, the Metas, the Amazons, of course, the Microsofts that make up a bulk of his revenue. But how solid is that into 2027? Can he talk a little bit more about some of the data center spend and how much it's going to expand out of the United States? There's some extraordinary Bloomberg Intelligence analysis out there today that's showing that really the US spend is what's propping up the entire global AI spend. Europe has not been increasing its AI spend much, about 1% more broadly, whereas over here in the United States, it's up and to the right. So will we see it spread? And will you and I actually use it more? Only about 10% of people are surveying, saying that they're building products and they're winning revenue for their companies at the moment by using generative AI.
I think Nvidia is not the company that we're worried about, right? The concern is, are we seeing ROI on CapEx? And Nvidia is the one getting the CapEx. But if you look at the SPLC on Bloomberg, that's the supply chain function, that's really fantastic. Right now, you've got a 3-month price change in there. But if you put in a 5-day price change, you would see all red, right? Microsoft is down over the past 5 days. Meta's down, Supermicro's down, Amazon's down, Alphabet's down. I mean, the whole tech sector is down over the past 5 days. So it's not like buy on the rumor, sell on the news is terribly likely to happen today because there hasn't been a lot of buying into this report.
There hasn't. $1.8 trillion has come out of the NASDAQ since the end of October. $500 billion of that is down to Nvidia. And yes, Nvidia is going to get the wall of money in this fiscal capital expenditure money circle that we keep seeing, but will that continue?
I like that.
Look,
it is a money circle.
I mean, look at what Anthropic announced yesterday. More equity coming from $10 billion from Nvidia, $5 billion coming from Microsoft, and in return, they're going to use GPUs and innovations from Nvidia.
Which, by the way, the market didn't rally off the back of that.
No,
in the past, when we'd hear stuff like that, it would rally.
Yeah.
So it feels like something has changed, at least with the circularity of it.
I think people aren't loving that. They're not applauding it anymore. Instead, they're worrying about it. Over in China, there's yet another new DeepSeek. Moonshot AI a couple of weeks ago released a new LLM that is beating out all of the competition. How much did it cost to train? Reports are about $5 million. Is there a question that innovation will happen, that inference isn't going to be so necessary for the latest Rubin or for the latest Blackwell? Can we do more with less? And I think that's what he's really got to prove out once again. He can continue to innovate that makes his chips so necessary. It doesn't matter if Amazon's making their own, if Meta's making their own, if OpenAI is making their own with Broadcom.
All right, definitely excited to watch your program today. Caroline Hyde anchors Bloomberg Tech. That kicks off at 11. By the way, her co-anchor, Ed Ludlow, is going to be sitting down with Jensen Huang after the earnings. So tonight at 6:30 p.m. Wall Street time, if you're not out to dinner yet, go ahead and tune in. And if you are, you can see it on Bloomberg.com. And, of course, you can listen to it on Bloomberg.radio. This is really an exclusive interview because we'll be the only news outlet talking to the Nvidia CEO after earnings tonight. Turning to retail, because we have a ton of earnings coming in. September retail sales report. That report has been rescheduled for the 25th of November. Maybe that's what Michael Burry was talking about. This morning, though, we get results from Target. Target narrowed its profit forecast, as we were talking about. Discounts and slowing demand weighing on earnings. Bloomberg retail reporter Emily Cohn joins us now. So what are we learning about the consumer that we're already a little bit worried about, Emily?
Yeah, I mean, Target is seeing a consumer that is choppy in its spending, not leaning into the discretionary things that Target is known for. The retailer trimmed its forecast again, signaling that its rebound is going to take a bit more time. And despite an exciting announcement about a partnership with OpenAI, which boosted Walmart's shares, Target is down this morning on its trimmed forecast for the year.
How does this set us up for Walmart tomorrow?
So Walmart is in a different position. Walmart has really leaned into its value orientation. It's brought in higher income shoppers who are looking for a deal. Its grocery assortment is bringing in people who otherwise might have shopped at a more expensive grocer during these times. So we're looking at Walmart. TJ Maxx was also another interesting one this morning. I think TJ Maxx is pulling in that discretionary shopper who's looking for value, looking for a deal, looking for fun.
Is it fun, TJ Maxx? Do you like TJ Maxx? Because I've heard from a lot of people on our staff. You know, our executive producer, Ann Torres, she says when she has had a bad day, you know, rather than a glass of wine to unwind, she'll go to TJ Maxx.
Yeah, and I think that actually speaks to part of Target's problem. Look, like, you don't go to TJ Maxx because you need stuff from TJ Maxx. You go to TJ Maxx for fun, for discretionary things, for things that you wouldn't otherwise.
Can you do that at Target, though? Like, you go because you're like, I need to go get some more toilet paper, and then you're like, oh, cool, like a little running top or something.
There's no hunt, right?
That
I think
is true.
the
There's
idea
no
is that
hunt.
you get to hunt through. But, you know, Romaine Bostick says it's just too messy for him.
Yeah, I get that. Look, if you are a ball of anxiety like I am, sometimes that's very difficult to bargain hunt.
I think that's exactly Target's problem. I think that used to be what boosted Target. That used to be what they were known for, and they've lost that. And now they're trying to bring it back.
More bargain hunting. Emily, thank you so much for joining us. That's Bloomberg's Emily Cohn. Now, in other retailer reports, Lowe shares are climbing. They did, though, trim their outlook, but they reported strong online sales, growing demand for professional contractors, a stark difference from rival Home Depot, who had earnings yesterday. Bloomberg Intelligence home builder analyst Drew Redding joins us for more. Drew, how much of this is just the fact that Lowe's was down 11% heading into this earnings this year, that it was down yesterday off the back of Home Depot, so expectations were incredibly low?
Hi, Dani. I think you make a good point, and that's certainly part of it. The bar had been lower coming into the quarter. So I think this was really, you could characterize this as better than feared results, particularly in light of what we saw from Home Depot. As you alluded to, they did trim their full year same-store sales guidance. Now they're looking for flat comp sales versus flat to up 1%. So that would imply that 4Q is relatively flattish. First consensus was looking for about a 1% gain. You know, so big picture, I think that Lowe's is still facing some of the same challenges that Home Depot is, whether it's, you know, challenges among the consumer and housing in particular, which just hasn't reaccelerated despite the pullback in mortgage rates.
I wonder about the, you know, the immigration problem that has hit Home Depot a little bit harder, right? ICE likes to go to HD parking lots to round people up, but also, you know, they must be losing customers because of that. Is that affecting Lowe's at all?
This isn't something that we've heard too much of. As you alluded to, Home Depot does get a larger share of their business from professional contractors at about 50% compared to roughly 30% for Lowe's. It is in an area of the business that they're expanding. But to your point, we haven't really heard of any direct impact to sales, from immigration actions. But I think that it's something that both retailers will probably need to address in the near future.
All right, Drew, thanks very much for joining us. Drew Redding talking to us about Lowe's, which is where I would go if I had a bad day, just to chill out. Check on futures here. We're looking at gains after 4 days of losses. It's actually been the worst month since March, and we're only down about 3%. It's the worst November since the great financial crisis.
That is a statistic, but that's because November is usually good, right?
That's exactly
it doesn't mean
right.
that it's just like
That's exactly
so
right.
bad.
Yeah, November is normally a banner month.
Right. Speaking about nerves in markets, we know private credit has been one of them that's been percolating around. Some recent breaking news from Blue Owl, the credit giant. It has called off the merger of its two BDCs. Those were two private credit funds. One was publicly listed, one was not publicly listed. And the idea behind that was they wanted to combine them, would give more liquidity. But if you were in the non-publicly listed one, you wouldn't be able to have any redemptions. And Matt, that caused a lot of fear. Why would Blue Owl not let you have redemptions? Of course, for them, they said it's because they had to combine the two. But that caused a sell-off. And again, today, just announcing that they have called off the merger of these two BDCs.
Yeah, I think this is a very interesting story about kind of the tail that wags the dog, right?
Yeah.
The market is telling Blue Owl what it can and can't do right now, and that is a sign of stress. I just want to point out, I've gone through the seasonality chart for the S&P 500. 29 years is as far back as I can go, but if you look at the average over that time period, November is typically the very best of all 12 months.
Better than December, even though the Santa rally and all that.
Yes, yes. December over the last 29 years averages a gain of 0.9%, whereas November averages a gain of 2.6%.
Okay, so maybe this will be a November to forget then. We won't get that rally. Elsewhere, Matt, the U.S.-Saudi Investment Forum is taking place in Washington, D.C. Bloomberg's Amer is sitting down with the CEOs of ACWA Power, Aramco, and Chevron. Let's listen in.
Positioning itself, the real energy transition for Saudi Arabia, but for the world. And Saudi Arabia is going to be a major player, in this regard. And we have many partners. We are very proud with our partnership also with GE. GE is really working with us now more than 20 years. And I have to say that with their innovation and their development, they have been really a great partner that we are making. Baker Hughes, we are working with them now in using their technology to produce electricity from green hydrogen for the AI. And I'm sure that everybody knows that the AI in the state and everywhere else, it's going to be the new energy change. Because we are talking about normal growth in the world, 1%, 2% of electricity. Today, we are looking at 10%, maybe more than 10% growth. For how you could make this electricity, Saudi Arabia is the only country, I have to say, they have been very well prepared for this infrastructure of electricity, of the grid, of the production, to be the host of the AI. And Saudi Arabia will be the export, really, of data, and will be the hub of data. Why? Because Saudi Arabia is positioning itself. It's really the host of the energy, but this energy, it become a key component. And I'm sure 60% of that cost of the AI compute is going to be energy. And who could compete today? And thanks to His Royal Highness, the Crown Prince, yesterday, and our Prime Minister, President Trump, this agreement, it will be unlocking this huge opportunity of Saudi Arabia is going to be connecting the world on data. Is it Africa? Is it Asia? Is it Europe? Is it the state? Saudi Arabia will be the hub of energy, but the hub of data and AI connectivity to the world. That's the reason this partnership with the United States of America, we cannot find any better partnership, trusted partnership in this journey, but we complement each other. And we are not here to create any competition at all, directly or indirectly. Is it in the energy or in the AI? We are here to complement this partnership and make this partnership to improve quality of life of people in the world, to have a better life, but also to have a great, development of young youth. Because Saudi Arabia, as our Crown Prince always said it, in Saudi Arabia, we did not have the oil. With due respect to Amin, he will get only upset from me. But we have the young youth. This is the real energy of the world in Saudi Arabia. Without this young youth, we will not be where we are today, and we cannot deliver our ambitions and our strategy of the future.
I believe 60% of Saudi Arabia's population.
That's Bloomberg's Anne-Marie Hordern speaking with the energy CEOs at the U.S.-Saudi Investment Forum in Washington. You can continue to watch that conversation and the whole event at LiveGo on your terminal. Meanwhile, at the Bloomberg New Economy Forum, Apollo's Mark Rowan downplayed Jamie Dimon's concerns that there are cockroaches in credit markets, but he did warn of late cycle dynamics.
Credit stats are actually improving rather than declining. That does not mean we will not have late cycle banking behavior, because there are good banks and bad banks, and good insurance companies and bad insurance companies, and good asset managers and bad asset managers. But there's nothing that I see that is systemic.
That was Apollo's Mark Rowan speaking at the Bloomberg New Economy Forum. Now, credit markets are far from a panic, but there is one corner that caution appears to be seeping in. At least for the public debt market, spreads have started to widen on the debts on the AI-linked giants, from Oracle to Meta. So what's happening in private markets? I'm pleased to say joining us now is the private credit and private markets powerhouse Fortress co-CEOs Jack Neumark and Drew McKnight. Thank you both so much for joining this morning. And I wanted to start on this topic of AI because, of course, you are participating in the energy of AI, in some of the real estate. And Drew, of course, you're a UVA alumni, which makes you a genius in all things. So, Drew, I want to know, with some of the fear in AI creeping into public debt markets, is that risk accurately reflected in private markets?
That's a great question. I think if you look at just the sheer amount of capital that AI that was required for AI, it's consuming massive amounts of capital. And so I think what you're seeing in the credit spreads of some of the Metas and Oracles of the world are just a reflection of the amount of capital that's going to be consumed. I think, we're big believers in AI. You can be big believers in AI. You can also question what the investment returns that are going to be yielded through some of these infrastructure investments, because just the sheer amount of capital and, will the revenues produce the amount of capital? A lot of folks like to point to the internet bubble in the late 90s and early 2000s. Obviously, the internet was a wild success, but the amount of capital that was required for infrastructure didn't match the revenues in the early days. And I think what you're starting to see reflected in some of the credit spreads is just that question around whether the revenues are going to be there to support the amount of capital that's been spent and the amount of capital that's going to continue to need to be spent as the upgrade cycle flows through.
Jack, let me bring you in on this, because a lot of your peers have been inking monster deals. Again, yours has been more on the energy side and some of the real estate too, but we've seen some of your peers tens of billions of dollars financing packages with Meta, with other big giants like Intel. Is there a sense that deployment has gone too far, to Drew's point, that sometimes maybe the revenue won't fully reflect the capital expenditure that's being done?
Yeah, I think from our perspective, we find it tough to predict, what the future is going to look like. As Drew said, what's the use case for data centers? How much capital needs to go into them in 5 to 10 years' time? So I think from our perspective, we've been focused on investing in, the companies that are providing services around the AI space. We made an investment in a company that owns 30 mobile turbines. Those mobile turbines are used to provide temporary power to data centers. That's a hard asset that we can get our hands around. We have the ability to reposition those assets to other use cases that are outside of AI. So I think from our perspective, that's a better way for us to play this investment than compete with the firms that are focused on writing these multi-billion-dollar checks into the data center space.
Jack, just on that, is you don't want to compete because of the size of it, or there's just too much risk in there?
Well, I think it's a combination from our perspective. Those are massive checks. And so I think you really have to have a lot of conviction. And to compete, you have to have a lot of capital. And so, we like to focus on areas where we can have an edge. And I don't think we necessarily have an edge to compete in these big data center projects. And again, I also think when we look out at the spectrum, it's tougher for us to have the conviction that, we know what these assets are going to be worth 5 or 10 years in the future. And so we'd rather invest in other types of services or assets that we have a better picture on the long-term visibility of values.
Well, let's talk about where that edge is. And Drew, Fortress has a history of being very active in the regional banking space. In the summer, you gave an interview where you said there's going to be an opportunity set in private credit because of the gaps that exist with small and regional banks. I wonder, does that sort of hint at a dislocation that still exists within the regional banks, that there are still some cracks there that maybe the rest of this market doesn't fully appreciate?
Sure. Look, I think if you look at the growth in private credit over the past 10 years, a big part of that growth hasn't necessarily been the overall credit pie growing. It's been what we now call private credit and capital from private equity firms filling the void that both investment banks, post-financial crisis, and regional banks have left. As you've seen regional banks pull back, I think we've seen that opportunity really since 2023 when you saw the regional banks pull back post-Silicon Valley, Signature Bank, First Republic. You saw a lot of banks reassess their liquidity requirements, reassess their duration, and that's where we've seen a big opportunity in private credit, and for us specifically in the asset-based credit space, where we've been quite active. We've had a business going back to 2002, but really in the past, call it 2 years, we've really seen that opportunity set expand, and that opportunity set has expanded not by us doing anything different, but by regional banks deciding they want to pull back or need to pull back because of some of their own liquidity issues around the fractional banking system.
Well, Drew, one of the reasons I ask, and I understand that, but one of the reasons I ask is also because we were just hearing from Mark Rowan speaking to Bloomberg about these late cycle dynamics where they're, in his words, good banks and bad banks. There have been some very high-profile blow-ups when it comes to things like Tricolor and other investments. Again, that's been both in private credit and the banking system. You have so much experience in some more of these distressed assets. Drew, for your has the list of stressed assets, the watch list, has it been ticking up recently?
Look, I think both Mark and Jamie Dimon can both be right. I do think credit events like Tricolor and First Brands are showing signs of some folks and some competitors that are probably getting out ahead of themselves and aren't doing the proper amount of diligence in researching their investments and structuring their investments. And I think, just like Mark said, there's going to be good asset managers and bad asset managers. One of the things that we've said for a long time in the credit space and the private credit space is it's going to be hard to tell who's doing a good job when defaults are very low, right? Because the reality is in credit, if you get paid your coupon, you're going to perform as expected. And so I think if you look back, and really private credit as a distinct asset class came about post-financial crisis, we've been investing in private credit going back all the way to 2002 when we founded the credit business at Fortress. But it's really hard to differentiate yourself when there's no defaults. I think when you start to have some defaults, you start to have just a normal credit cycle, a normal investment cycle, economic cycle, you're going to start to see variance in returns. And from our perspective, we've always invested deeply in the asset management part of the business, which means taking care of those assets if you start to have the watch list. And so as we look forward, I do think you're likely to have a little more volatility, right? The economies, I think there's a lot more uncertainty around the economy. There's a lot more uncertainty around interest rates, geopolitics. That's going to lead to potential defaults. The good part about credit, if you structure it right, is you don't have to lose money if you have a default, right, if you've got a well-structured loan. And so from our perspective, we actually believe this is an opportunity for us to really outperform and start to differentiate differentiate from a performance perspective.
Jack, I'd love your take on this because you have a career history in focusing on bankruptcy, restructuring, litigation. Is now the time to focus in and brush up on all the restructuring skills needed?
Well, I think the restructuring world has changed a lot. When you go back and you look at the world of distressed debt that some of us grew up in the aughts and great financial crisis, that was a world in which, you had a bunch of groups of lenders trying to work out restructurings inside of the context of the bankruptcy courts. I think in today's world, you're seeing a lot more emphasis on out-of-court restructurings and liability management exercises. And so I think when you look at what the default rates actually are, there's a question of what you're including in those default rate calculations.
Yeah.
But I agree with Drew. I think that, ultimately asset management here is going to be a key differentiator. Firms that are able to take agent positions or control the loans that they're involved in, that are able to have financial covenants that give them early warning signs and the ability to negotiate amendments early in the process are going to be the ones that are best positioned. And to the extent you're inside of a bankruptcy, I think it's
Jack,
going to be focused on your
Drew, just because we only have a minute and we have to address this, the fact that if we had been doing this conversation a month and a half ago, it would have looked very differently with the tragic passing of your colleague and former co-CEO, Josh Pack. Drew, again, just a minute here, but I would love to get a feeling from you, just the legacy he leaves behind.
Look, Josh and I had worked together since I joined Fortress in 2004. The first investment I made in Fortress was alongside Josh in the bank debt of Krispy Kreme donuts. I think one of the things as we've had to take a step back and reflect on just what Josh meant, not just to the firm, but to each of us personally, it's actually been, I think we've all drawn some strength and some inspiration around what we want to do together to help realize that legacy. Josh, what I said to folks is I know a few things. Josh loved his family and he loved Fortress. And so the best thing we can do is do our best for his family, but also do our best for Fortress to help build that in his legacy and his vision.
Thank you both so much. That is Jack Newman and Drew McKnight of Fortress.
We are moments away from the start of trading on Nvidia Day. This is Bloomberg Open Interest. I'm Matt Miller. We're looking at futures. Really little changed here after 4 days of drops on the S&P. NASDAQ futures also not moving much, nor are Russell futures. We've got, quite fittingly, an AI infrastructure acquisition SPAC ringing the opening bell on the NYSE. And this I think really focuses the mind on the question the market is asking. Is all of this CapEx going to be rewarded with return on investment? You got big brothers, big sisters ringing the bell down at the NASDAQ market site. Fun day, fun activity for them, and a really great charity to participate in or to give to. Dani, in terms of the stocks that we're watching, I guess one stands out front and center.
Yeah, and it's going to stand out throughout the day. If it ends the post-market session this way, I mean, it will be impossible to know. But Nvidia at the moment is up 1.4%. I mean, look, the direction of this monster stock will dictate the direction of the entire market when it reports after the bell today. Options imply a move of 7% in either direction, which is about $300 billion in market cap. So we could add that, we could take away from that. But from its peak in October, Matt, Nvidia is already down 12.5%.
All right, we are also focused, though obviously less so, on retailers. Target is the latest retailer to narrow its profit forecast as consumers get picky. Target cited discounts as well as softer demand for the revisions. Those shares are down 2.4%, but Nvidia is obviously the most important company to watch in this market, the biggest company in the history of the universe. And joining us from San Francisco is a man who knows this company well, Bloomberg Tech co-host Ed Ludlow. Ed, you're going to sit down with Jensen Huang for an exclusive interview after the earnings this evening. What do we need to to get set up for the results?
Yeah, there are very high expectations. At a minimum for Nvidia to move the needle, they'd probably have to far exceed consensus, which is more than 50% revenue growth, more than 50% net income growth. And then a lot of focus will be put on the forecast for the fiscal fourth quarter. But, the calculus for Nvidia is quite simple. 40% of their customer base is the hyperscalers plus Meta, and collectively they are forecasting CapEx growth beyond 30%. And it simply comes down to, for many investors and the industry writ large, is that CapEx forecast right? And does Jensen Huang signal any sense that actually they won't go through with it? Loads of questions: depreciation of older chips, the circular financing thing, and bigger picture, longer term, electricity. Is it there or is it not? But it's a very high bar, and there is, as you guys know, increasing skepticism around the revenue generation of those that use GPUs from Nvidia to train models and the software side, but also valuations right now more broadly.
Ed, and you're, of course, going to be sitting down with the man himself, Jensen Huang, at 6:30 tonight. You mentioned some of the big questions outstanding for the company itself. What is your top priority in your conversation with Jensen Huang? What will you be asking the man?
Yeah, I think that depreciation is very top of mind for a lot of people at the moment. But long story short, Nvidia commits every year to having a brand new generation of GPU. And there is a high concentration of customers that have millions and millions of now obsolete GPUs running in data centers that are pending being swapped out for the latest cutting edge chip. And there are two ways of looking at it. You can either say, well, those older chips are running at 100% utilization, and so just swapping them out is a good thing. But you then have to look at the balance sheet of those companies that bought the older chips and how they are working that out mathematically if they are to be depreciated. And then, yeah, I kind of mentioned it before, but Jensen Huang really has a lot of confidence about the staying power of this infrastructure build out. But he only controls one side of the supply chain. There are lots of questions about whether they see material ability for this country, in particular the United States, to supply electricity or the energy that's needed. So that will be a big part of the conversation.
All right, Ed, great to get some time with you, and really look forward to both your program at 11 a.m. Ed, of course, co-hosts Bloomberg Tech with Caroline Hyde, and he will, as I said, sit down exclusively with the CEO of Nvidia, Jensen Huang, live at 6:30 p.m. Wall Street time. So tune in for that. You can hear it on Bloomberg Radio. You can watch it on Bloomberg.com. Business leaders are raising red flags around tech valuations as investors better understand the economics around AI. Here's Algebra's CEO, Davide Serra.
If we're not going to find $2 trillion of revenue to justify the AI revolution, which I think is impossible by 2030, given the level of public debt around the world and where taxes need to go to pay for this debt, the likelihood is we're going to have a significant correction.
Joining us around the desk is Morgan Stanley Senior Portfolio Manager Andrew Slimmon. He sees the current volatility as classic late cycle behavior. So, first of all, it's great to have you here in the studio.
Thank you.
We're typically down the line with you. So, when you say late cycle volatility, that makes me think we're nearing the end of possibly a bubble. Is that how you see it as well?
Yeah, the question is, the late cycle can last 4 or 5 years, or it can last like in 2021 for 1 year. And so I think I would argue that all this skepticism about this big technological revolution we're having is good news, because it's keeping the valuation, it's keeping the bubble down in these stocks. Now, off the low of April, what I saw was the best thing to invest in were not the hyperscalers, it was the money-losing tech stocks. That did the best until about 3 weeks ago, and that's kind of started to deflate. So I would argue that this, as I said before, this level of skepticism, it's good news. It's keeping too much, it's keeping the valuation down.
There's like a good meme about this of someone with a bloodied up shirt, and like the strategist is saying, no, the correction's good for you. You're feeling pain, but it's a healthy thing.
Well, that's true, because think about it. In 2021, the bubble grew so quickly, so fast that when it burst and those SPAC meme stocks came down a lot, it really hurt the market a lot. So I'd rather keep it down.
So we have seen 4 of the Mag 7 stocks underperform the S&P 500 this year, which I had to double check that when I saw it in Dan Curtis's note this morning. Do you buy those stocks?
Well, the stocks have underperformed, but the earnings haven't. They've all beaten. Right, so that means the valuations have come down. So if you liked them at the beginning of the year, you must really like them now because the valuation's lower, right? But I go back to, if you listen to third quarter earnings report, what I heard these companies say is, we can't keep up with demand. We can't keep up with demand. This is very different than the year 2000 when the demand for routers was slowing, and the telecom companies were saying, we've got a lot of dark fiber we're not going to turn on, right? This is a very different environment. I think it's early cycle in the AI. It doesn't mean it's early cycle for investors. The market bottomed in 2022. We're fourth year of a bull market. It's late cycle.
Andrew, one of the things I do know that you are worried about, that you've been writing about, is the dynamics that are going to start early next year. When you have a Fed embarking on their cutting cycle, at the same time, we're going to get checks handed out and tax refunds from the one beautiful bill or tariff refunds, what have you. Stimmies
right.
For everybody.
Remember, 2021.
The Oprah economy, you get a check, you get a check. What is your concern about how that could play out?
Too much liquidity. And too much, didn't we learn that in 2021? Everyone got liquidity. What they did, they traded stocks. And so it inflated the bubble. And so I think if the Fed were actually to go slowly, I think one of the reasons why you've seen some of the deflation and some of this bubble come down in some of these very speculative stocks is the chance the Fed may not cut in December. I'm not a Fed expert, but I would argue that's good. That keeps it, keeps the, kind of the speculation down.
What do you like that's divorced from the whole AI trade? I mean, we're talking today about retail earnings because they're concerning, so right. I imagine that it's not that.
That ain't that.
Yeah. But is there, healthcare, I realize, for example, there's an AI play there, but it's a separate thing, and a lot of people are very bullish healthcare.
I'm not.
No.
I'm not, because I think it's very hard. You have to get two things right that are really hard. One, you got to get the drug right, and then you have to get what happens politically in Washington, D.C. about pricing right. And I think that's very, very hard, someone that's been in this business a long time. I would say if you listen to banks, the banks all had great numbers. Follow the numbers. The banks blew out. Why? More capital to invest. I think that's the other really big opportunity. Could that be correlated? Well, maybe, but to me, the big banks and the loosening of capital, I think it's a great other story.
And look,
that's happening outside the U.S. also.
I don't want to. I'm going to ask this question. I don't mean to say that big banks are now an AI trade, but there is this feeling where there's a great story in the Bloomberg today that big banks are writing a lot of these AI checks for financing just because of their sheer size, they're allowed to do it. But it's funny because Matt asked, okay, what besides AI do you like? Is there not a concern that just so much is correlated right now, that it's like utilities is AI, infrastructure is
100%.
That it's even hard to
Correct.
Answer Matt's question because so many things are connected.
I have a very simple way you're going to find that out. Go back and look how your stock did the day DeepSeek came out. Because the day DeepSeek came out, some of those utilities, that were not sectorally in the technology area, they went down a lot. And some of those industrials went down a lot. So it's a great way to measure what truly your correlation. But I think you've nailed it. I think that's a big risk. Everyone thinks they're sectorially diversified, and they're not so much because they're really playing the AI trade. And I think emotionally, investors go, well, I missed the well-known trade, so now I'm going to find something tangential. But what we learned in DeepSeek is they're all correlated.
Also, it is a great story by Hannah Levitt and co. on the banks, talking about how much they stepped up with to underwrite the acquisition of Skechers, $8 billion. Warner Brothers Discovery, that split $17.5 billion. Electric Arts, $20 billion, a check from JPMorgan alone for $20 billion. None of those are really AI.
No, it's true.
Right? So it's a play on the real economy.
And trading also. Capital has been freed up for more trading, and I think some of these big banks made better profits in trading.
So there's more capital freed up because of deregulation,
Correct.
right? More liquidity in the system, and that's going to play out at least for the rest of this administration's term.
Correct.
How else?
Stocks trade at 30% discounts to the S&P.
So how else do you play that? I mean, the money flooding in, because it's not great news for inflation, right?
Correct.
Yeah.
Goes back to the original. That's absolutely right. But I think it's the money center. I'm concerned the alternative. If you watch the alternative stocks,
you mean the alts, like private equity, private credit?
That index is not doing well.
Really poorly.
So is that a credit problem, or is that there's going to be more competition in your world? I think it's the latter.
Jamie Dimon would be very happy to hear you say that. Andrew, thank you so much for joining us this morning. Please come in again soon. That's Morgan Stanley's Andrew Slimmon. All right, let's get a check on your equity market this morning. I guess we're all just bracing for Nvidia earnings, but we are higher by 1/3% after consecutive days of declines. Breath is not good, though. Feels like it tends to be the case for these up days. 193 stocks up, 307 are down. Nvidia is what's leading us higher, 2% higher after on track for a tough month. By the way, it's going to be the first time since ChatGPT was announced that the past 30 days heading into an earnings call that we've seen Nvidia decline. That's according to Deutsche Bank. On the downside, it's other tech players, Amazon, Meta, Microsoft, Exxon. A bad day for energy today. If you look at what the sectors are doing, energy is faring the worst out of all of them. I promise you that will be coming up shortly, that we have energy doing poorly. In the meantime, Netflix, Berkshire, there we go. I knew it was there. Actually, it is apparently flipped.
Yeah, it's
actually, I don't think this is it, Matt, because it says we're currently down 0.8%. If we can get a little refresh there, and we're currently up on the stock market. So maybe don't believe anything you're currently looking at, and I will leave it there, Matt.
That's interesting.
Right, this isn't it, right? We're up currently.
Well, I'm looking. I got to do SPX L1 index GRR go.
Yeah.
And yeah, you're right. That's wrong.
Yeah.
Whatever you're looking at there is wrong.
Don't look at this. Don't look at that. Matt, take it away.
I don't think it was typed in correctly, because I do see energy as the biggest loser by far, gapping more than 2% down, and the big gainer, up more than 2%, is communication services, which is what we call the hyperscalers. We'll sort that out behind the scenes. When we come back, TMX Group is stepping up its U.S. Footprint with a new Manhattan office. We're talking about the Toronto Stock Exchange. CEO John McKenzie joins us next to talk about the expansion and whether prediction markets could be the next big frontier for exchanges. This is Bloomberg Open Interest.
Let's look at some top calls, the analyst action that we are following. First up, Molson Coors. They get downgraded at Wells Fargo, where the analyst says that the brewer is facing weak category trends and share losses. Meanwhile, rival Anheuser-Busch offers strong growth potential into 2026, those shares down more than 1%. Next up, Jefferies, they upgrade DoorDash. They say the company's annual forecast has reset expectations. It had its biggest drop ever after it reported earnings earlier this month. They say that it still has room to invest and beat estimates. They cited faster growth in restaurant delivery and calls DoorDash strong execution underappreciated. After the recent sell-off, that not helping shares this morning, down 2%. Finally, Wall Street is weighing in on Amer Sports after raised guidance for the third time this year. Truist and Evercore ISI called the update a confidence boost following recent sentiment drag. Citi called them a standout retailer, and Nomura raised their rating to a buy because, Matt, everyone owns those Solomon shoes that they sell. Like all the West Village girlies are wearing their little hiking shoes every day out there in the wild.
Do they make Wilson tennis rackets also?
And yeah, the clothes. So okay, yeah, I support this company also.
Yeah, I thought you might use those on occasion.
Correct. You have called me out, actually.
Let's get to the Toronto Stock Exchange, planning deeper roots in the U.S. as we were talking about before the break. TMX Group just opened a new office here in Manhattan as part of a bigger push to grow its footprint beyond Canada. The CEO, John McKenzie, joins us at the table to talk about the company's growth. So, John, it's interesting at a time when there are growing divisions, at least in the capitals, between the U.S. and the Great White North. You're pushing further into the South.
I mean, we've been doing this for years, so we weren't going to stop just because there's any changes in administration. The Canadian and the U.S. capital markets, you know this, are the most integrated markets in the world. And so for us to keep growing globally, U.S. is a natural point to that. And we've got ambition to keep growing the firm. We've been growing it on what we call our 2X, TM2X strategy. We've almost doubled the firm in the last 5 years. And that means really investing in core markets like the U.S. and Europe, because that's going to be where we're going to get the larger expansion. So we're now more than 50% of TMX is outside of Canada, even though we've got that strong Canadian footprint.
I believe the first ETFs in the world were in Toronto, right?
Invented on the Toronto Stock Exchange over 35 years ago.
Yeah.
By the way, I love in the video of your office, we saw some pretty cool snacks. I think that's important for opening up any office. So you're talking about this immense amount of opportunity in the U.S., but in some ways it's a double-edged sword because these capital markets and formation here in the U.S. are saturated. There's mature. So where is there a gap?
Yeah, that's such a good question. And part of that gap, we've actually been doing this for 173 years as well. So we've got deep innovation, expertise. You mentioned it. We invented the ETF in Toronto. The first fixed income ETF happened in Toronto 25 years ago. So there was natural things that we could bring to the U.S. market. And when 2 years ago, I was down here in New York, I was able to put our entire business team around a dinner table of 8. Now we have over 200 people in the U.S. across multiple business lines supporting energy, indices, as we talked about, ETF support, new data operations that we brought in this year. We launched a new trading market this year, very much focused on capabilities we built in Canada that we saw an unmet need for here. So everything we're doing is based on where we believe we've got capabilities that add value to the clients, not just to be another player.
One of the things that you might have to imitate rather than innovate is prediction markets. ICE is buying one, and it seems to be like the hottest new thing. Are you looking to get into prediction markets? And then where do you draw the line between, finance and sports betting?
And that's the real question, and that's the regulatory question on this as well, in terms of what is investing and what is gambling. At the end of the day, we believe our client base is to serve the brokers, the dealers, the asset managers that go out to the retail investors. Our retail side is more about investor education, information, content, helping them understand investment options. So for us right now, we don't see us being kind of first mover in that space. But there's a lot of trends like that our team's got to make sure we're up to date on. Not just prediction markets. We need to be ready for 24/7 if the U.S. market moves. We need to be ready for tokenization if there's a greater interest in tokenizing, equity assets. So all those are on the table in terms of investing to make sure we're ready. But it's unclear in all these where the real demand's going to be in the investment market in terms of the real money demand.
When, again, something like a prediction market, though, because it feels a little bit like the Wild West at the moment, do you think that this is, and people are calling it an asset class? I mean, Cliff asked us if AQR was in the building talking with Odd Lot, saying that they're going to start maybe trading sports prediction markets. Does it make sense, though, for you to say, okay, this should be under a roof where we have the expertise and we can deliver it versus like a poly market or whatever sort of else off exchange thing that exists that maybe has a little bit more risk within it?
Yeah, if you think about that crossover, and it's not just those markets, you've got other markets that are looking to provide not just predictive pieces, but stepping into other tokens on equities, things like that. If they're going to move into the investment space, why wouldn't we expect that everything we've built around investor protection, liquidity enhancements, separation of assets, why wouldn't that apply there? Would we want that same protection? So I do think that there is an element that there's a blow up waiting to happen on some of these. That's going to put shine a light on it, and we're going to look to, okay, how do we bring the same kind of scrutiny to this, just like we brought to crypto markets a couple of years ago?
By the way, just quickly, about 45 seconds. Are you staffing up with ETFs? There's been a divergence with some of the exchanges on whether they're adding or subtracting.
We are adding. So ETFs both in the index building to create indices for ETFs, but also the support of ETFs in the Toronto Stock Exchange. This year we've already listed over 200 new ETFs. So this is absolutely a place we're investing in Canada, in the US, and also in Europe as well to help build out the European market.
John, this is great. Thanks for stopping by on your trip through New York. That is TMX Group CEO John McKenzie. Now, coming up in the next hour, MFS Investment Management Ted Maloney on his firm's focus on public markets over private markets. You're watching Bloomberg.
This is Bloomberg Open Interest. I'm Matt Miller. Let's get a quick check on stocks. We are, 6 hours away from Nvidia earnings. S&P 500 doing quite well, up 0.7%, although it's the first up day in 5. The Nasdaq gaining more than 1% on bets that Nvidia may do well. That stock itself is up more than 3%, and we see Alphabet shares also gaining right now 6%. So tech doing well. In terms of retail, we've had a ton of earnings. Target, Lowe's, TJ Maxx, and Williams-Sonoma all out. You can see those moves as well. Coming up in the next hour, JPMorgan's Gabriela Santos shares her outlook for 2026. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
And I'm Dani Berger, breaking 4 days of declines heading in to an Nvidia earnings day.
Yeah, markets are facing that crucial earnings test. Nvidia is obviously the world's most valuable company, reporting earnings. I mean, everyone knows that, right? It passed $5 trillion in market cap. But investors are still wary of the whole AI trade.
You can't say it enough. Meanwhile, Wall Street executives, they are urging caution. Goldman's John Waldron says that markets are primed for further declines.
And a cautious consumer. Retail results this morning signal shoppers are turning to cheaper options as the economy shows continued signs of stress, but not really distress quite yet.
No, or like not stress if you're looking at TJX. People are buying that.
Apparently, it's a fun place to go. We begin with JPMorgan Asset Management releasing its 2026 investment outlook. The team writes, valuations, earnings, and AI look bubbly, but are underpinned by solid fundamentals. Investors should prioritize quality and focus on secular rather than cyclical themes. Joining us, we're pleased to say on set, is Gabriela Santos, JPMorgan Asset Management Chief Market Strategist for the Americas. So, Gabriela, what do you think about this, I don't want to say correction because we're only down 3%, but it's all the talk at our New Economy Forum in Singapore, and John Waldron says we could get some continued modest declines. Is that good?
I think it's healthy. We had 6 back-to-back very strong months of returns, just an unrelenting rally from those April lows. So absolutely healthy to see a 4% pullback for the index as a whole, and then closer to 6-7% for those AI-linked, as well as what had become some memes and themes that had run a little bit too far after the summer. So absolutely normal, and maybe it goes a little bit further, but we don't expect a big bear market or a downturn. I think it's just healthy repositioning. As you read in the piece, we would still lean into structural over cyclical themes. So that means for us, it's still the main AI story driving any of the excitement and opportunity in U.S. markets, rather than trying to chase some of the more cyclical stories in the market that we think had run a bit too far since the summer.
Is there a chance, though, that this is a narrative that really picks up steam? Because part of what's underpinning some of the losses, you see Oracle debt, for example, spreads widen, especially on their CDS of it, and CoreWeave, this idea that there's an overspending happening. They don't have the revenue or the return on investment to back up the amount of capital being put to work. How do you prevent that from turning into a narrative that's not just a correction, but something that's a lot more painful and unhealthy?
And I think what's been nice about this year is we're on the 3rd full year of this AI story, but it really evolved this year. If you actually look at that Mag 7 group, for example, or you put hyperscalers together, which include Oracle, what you see is only 2 of those stocks are outperforming the S&P this year, rather than the whole cohort like the 2 years before. So there's already clear differentiation of, are you monetizing this as an enabler, basically through semiconductors or cloud? Otherwise, the story has moved on to other enablers. There you see industrials, utility as some of the top stocks. And I think next year it'll evolve further, right? So still, which one of the big companies are monetizing the story with low leverage? And then what's next? And there we really think a lot about enterprise adoption of AI and their very solution-specific software, also the physical application of all of this through robotics and automation. And there, I think, worth looking at Asia for some of that leadership.
So there's really 2 themes here, right? On the AI side, are you going to get the ROI to justify the CapEx that we're seeing and hearing about? Yeah. On the economic side, this K-shaped economy, what are you watching to ensure you that the drag the lower cohorts are putting on the economy doesn't broaden out into a headline problem?
Yeah, we named the outlook for 2026 AI lift and economic drift. A little bit more of the same that we've seen this year. Basically, if you look at CapEx, for example, you're really only seeing that pick up in tech-related sectors, whereas CapEx in any other cyclical sector of the economy is moving sideways, including housing. We expect more of the same next year. If you look at consumption itself, it's actually contributing less to growth than AI investment alone, and it is very K-shaped. So for next year, a little bit more of the same. Growth around 2%, a little bit of a sugar boost early in the year from those tax rebates, but otherwise a good enough economy but not anything to get overly excited about. And there comes that focus of quality versus cyclicality, high beta, which is what we saw starting to lead after the summer, which we think was due for a pullback.
There is some stimulus, though, that's likely to come in the start of next year. There was a very recent interview with Scott Besson, I believe on Fox News, where it was Fox News because it was Brett Baer asking him, how do you make sure a $2,000 tariff check doesn't result in inflation? His answer was basically, well, we hope people will save it, not spend it. Historically, what people do is they spend it.
Of course.
In the U.S., for sure.
Especially. Okay, so
exceptional consumers.
Well, one, inflation concerns, but two, couldn't that make some of these consumer companies more attractive if all of a sudden people are armed with more cash that they're willing to spend?
And I think that's why when we finally got the One Big Beautiful Bill Act signed, and there was this realization that the tax cuts started this year, but the W-2s or the payrolls wouldn't be adjusted until next year. I think that gave that little pop to consumer discretionary, to small caps, but really we should see it as a sugar rush. Same with additional stimulus checks, which TBD if Congress would pass that. It would be a sugar rush. And American consumers really are exceptional at spending it, so we do think it would filter through, especially actually to consumer discretionary types of stocks. But then that's all you get. You get a technical bounce in those kind of companies, and then you're back to a slowdown later in the year, something that's a little bit more soggy and still quite cagey.
And reinforced moral hazard. I mean, John Waldron was also saying the consumer problem is that people are lending too much, right? And I guess we've been trained to understand we're going to get bailed out by some sort of COVID spending, stimulus falling from the sky. Now it's tariff refunds. Are you concerned about the U.S. economy on a broader level, on a longer term level? Because we're also spending like drunken sailors. No one seems to care, right?
Those two themes are really important for the long-term outlook. This idea that maybe there's a little bit more downside protection, and so you avoid some of the bigger drawdowns in the economy because fiscal's ready, willing, and able. But as a result, you could also get more pops on the inflation side. We don't think it's next year, but further down the line, if we keep stepping on this protein, stepping off the protein accelerator and on the sugar accelerator, then you will get more periods of inflation uncertainty. And that's why we talk so much about the 60-40 plus. Bonds really can't help you outside of a recessionary scenario, and that's why we talk a lot about private markets. Infrastructure is our favorite because it's a good combination of diversifying defense in portfolios, has a negative or basically an existing correlation to stocks and bonds, and it's a way to diversify the AI story through the power surge kind of story, specifically here talking about utilities and independent power providers.
Gabby, this has been great. Thank you so much for joining us this morning. Always wonderful to have you on. Gabriela Santos of JPMorgan Asset Management. All right, a check on markets this morning, about 40 minutes into your trading day after 4 consecutive days of declines. The NASDAQ 100 outperforms thanks to Nvidia, which is up today. This could all change after the bell when they report. But in the meantime, energy is the big drag on this index. Oil prices are moving lower, but most about everything doing okay, Matt.
Let's get a look at some of the single stocks moving right now. Don't forget that we have retail earnings out today. Target is the latest retailer to narrow its profit forecast as consumers get picky. It says discounts and softer demand are responsible for the divisions.
Lowe shares, those are climbing. They also reported earnings where they trimmed its outlook, but these things are down 11% this year. They reported strong online sales and growing demand from professional contractors.
Blue Owl is calling off a merger of 2 of its private credit funds. The firm terminated the deal after scrutiny over potential gates that it would have to put on the non-traded BDC to merge it with the publicly traded business, and investors want to be able to get redemptions when they want.
That's a fair statement. Okay, coming up, we're going to bring you part of our interview with NEC Director Kevin Hassert, happening right now at the Bloomberg Insights and Innovation Summit. Stick with us for that. This is Bloomberg. Let's go live right now. NEC Director Kevin Hassert speaking with Bloomberg Chief U.S. Economist Anna Wong at the Bloomberg Insights and Innovation Summit in Washington, D.C.
GDP growth be sustained at this 3 or 4%, while the labor market is going sideways, basically, with labor share probably going down, probably because of productivity gains in the future.
It could be that. And also, don't forget that there's been a big reduction in illegal immigration and employment from that aspect. And so the population growth is pretty low compared to what it was when we had tens of millions of people crossing the border. And so the break-even jobs number for the payroll survey is, people think, is down like quite a bit to maybe around 40 or 50,000.
Yeah, between
right?
30 to 60,000.
Oh, well, I was 40, 50, you were 30, 60. I think we kind of, we're about the same range, right?
Right.
and so that's like another thing that we could have big increases in productivity and big increases in output and a healthy labor market with job numbers like the one that you forecasted. And we'll see whether you're right or not.
So 54 sounds good to you.
I'm saying that
it's not 100.
That's enough to sort of keep up with population. You'd want stronger growth than that and unemployment to go down, but the unemployment rate's a little higher than what's probably the equilibrium unemployment rate in a full employment economy, but not a whole lot.
So Kevin, going back to this productivity boom, I recently tweeted a couple pictures that seems to suggest some emergent micro evidence of how AI is boosting business formations, and St. Louis Fed also has a piece out showing how AI adoption is correlated to rise in sector-specific unemployment. So, just evidence that AI is working through at the micro level. But then the response I got made me realize that it is actually a really polarizing topic. With half of if you survey a lot of people, half of them probably say AI is a bubble. Half of them would say that there's no evidence that there's a productivity boom yet, that productivity is still on trend, and the improvement reflect more of a cyclical thing that happened post-pandemic as opposed to this sustained AI-driven productivity. So we are going to touch on you being the one of the leading candidates for Fed chair. And going back to that 1995, 1996, those two critical years at the Fed, you mentioned that Alan Greenspan was really the only one of the few who saw evidence of productivity boom. And I reread the historical transcripts in December 1995, that particular FOMC meeting where half or more of the FOMC were agitating for holding rates constant, and in 1996, many of them wanted rate hikes. And somehow Greenspan was able to convince all these skeptics that something is afoot without the data to support
Let me talk about this, because there's an interesting anecdote that I don't think has ever been made public about this. So because computers were improving so quickly, then it was decided by the Bureau of Economic Analysis, a lot of great professionals over there, that they needed to what we call hedonically adjust the computer price, which meant that if you had a computer chip that was twice as fast as the one from last year and it costs the same, then that's like a big reduction in the price of computing. And so that in a typical year, right around when we were starting to have to make the judgment on this,
all right, that is NEC Director Kevin Hassert speaking with our very own Anna Wong in Washington of Bloomberg Economics. You can continue to watch that conversation on Live Go if you have a Bloomberg terminal in front of you, LIVE Go. And I mean, I think I would. It's so fascinating to see. Anna Wong has a reputation for standout calls. She's absolutely brilliant. And Kevin Hassert, he used to be a Bloomberg contributor, used to be the AEI.
Possibly the next Fed chief. Trump saying recently he thinks he's made up his mind and he think he'll go with the politically correct choice, I think.
Yeah, although he said he'd rather pick him. And he pointed to Scott Bessent.
Right, but Scotty doesn't want it. Scotty beef. Anyway, still ahead, Raj Dhanda of Ares Management on cracks and opportunities, what he's seeing in private credit. That's all coming up next. You're You're watching Bloomberg Open Interest.
Credit events like Tricolor and First Brands are showing signs of some folks and some competitors that are probably getting out ahead of themselves and aren't doing the proper amount of diligence in researching their investments and structuring their investments. And I think, just like Mark said, there's going to be good asset managers and bad asset managers.
That was Fortress co-CEO Drew McKnight speaking with us in the last hour. Let's continue the private credit conversation with Raj Dhanda, Global Head of Wealth Management at Ares Management. Raj, wonderful to see you.
Thanks for having me, Dani.
And look, you perhaps have the wonderful and difficult task of going to a broadening set of investors who are interested in private capital. Increasingly, this is part of the conversation, that there is a divergence. In the words of Drew McKnight, there are good managers and there are bad managers. Just how stark is that divergence getting, and how much more difficult does that make your task of educating people on this asset class?
Well, Dani, it's actually core to our education. I was talking to a top advisor this morning, and manager selection has always been at the forefront of our narrative. I think in these markets, you'll see a higher dispersion of outcomes. You'll see the best managers, and through history, the best managers are the ones that can discern between noise and fundamentals. And we think this is the time when you're going to need to do that, and you're going to need to be with managers that have been doing it for 30 years, have broad deployment, and can deliver the investment experience that they targeted.
So how has underwriting changed now versus, say, 2021? Are there terms you're just not willing to give that you see competitors doing?
You know, the underwriting process hasn't changed, and we benefit at Ares from a significant amount of our loans being with incumbent borrowers. Over half of what we do is with a borrower we've known for many different cycles or through different cycles. And so our approach has been consistent, and we've been fortunate that our credit portfolios are healthy, highly diversified, and they're built for environments where you get this idiosyncratic noise.
By the way, in terms of this environment, it's not just this noise, but it's the fact that we're also about to embark on a rate cutting cycle too. And, you know, we spoke to John Gray about this, that I did just mathematically, it means that returns start to shrink for private credit. How much more difficult is it then to find alpha in an environment where you get that compression?
Well, so I'd step back. Our approach to the private markets is to build an investment solution that's for all markets. Private credit in particular, the tailwinds to declining rates are pretty substantial. You get wider spreads, you get more deal flow, you get higher fees, and so actually private credit will benefit from a lower rate environment. But what we're trying to do is present the suite of solutions. We think there are opportunities in real assets, there are opportunities in sports. We think that the important role we play is to take that 4 or 5% allocation most investors have today to the private markets and grow it to a level that an institution or a large, sophisticated family office might have, say, 15, 20%.
By the way, one of the strengths that you can have versus others isn't just your underwriting or the ability to attract capital, but also to offer those solutions to the borrower, right? And to work with the borrower to make sure that those businesses succeed. You've got the experience. How do you do that?
No, that's exactly right. So having long-term capital and having a large portfolio management team that can work through difficult times with borrowers is core to our practice. And as I said, this is where, having been through the financial crisis, the credit crisis in Europe, COVID, we've developed a pattern and an ability to recognize where we can be patient, where we need to move on, and that's helping us significantly.
By the way, I know we have Ted Maloney waiting in the wings, the CEO of MFS Investment, who had one of the first mutual funds. And we're going to talk to him, saying that for everyday investors, for retail, for wealth, public markets are better. Part of that, it's an argument that Cliff Asness has talked about too, that it is this illusion of an illiquidity premium. But what you're actually getting with that is when these blow-ups happen, it's not as transparent. That is just frankly not as transparent markets, and that's not right for the investor class that you're working with every single day. What do you say to that criticism?
Well, I think they're missing the broader picture. So the asset class is clearly illiquid, and that also means that it can play an important role in a portfolio. The top advisors don't want to have their clients trying to trade during every turn in the markets. And so, again, the context is important. If you have 5% of your portfolio that's illiquid, that's incredibly reasonable. You have 95% where you can enjoy the volatility, if you will. So it's your starting point, and it's the investment outcome you're looking for. We think investors are looking for a risk-adjusted premium to the public markets. The private markets have delivered it through many, many cycles. And as I said, you can do it in infrastructure, you can do it in real estate, you can do it in sports, you can do it in private credit. The breadth of those solutions is really what's at the foundation of the dialogue we're having.
Raj, I wish we had more time. I hope you come back because it's a fascinating conversation. Raj Dhanda there of Ares Management talking to us about credit and his business. Coming up next hour, as Dani just mentioned, MFS Investment Management, in the next segment, MFS Investment Management's Ted Maloney on his firm's focus on public markets over private markets. This is Bloomberg Open Interest.
I would say you're seeing in the markets right now a pullback, which I think is healthy. Markets have run quite a bit this year, U.S. equity markets in particular.
If we're not going to find $2 trillion of revenue to justify the AI revolution, which I think is impossible by 2030, given the level of public debt around the world and where taxes need to go to pay for this debt, the likelihood is we're going to have a significant correction.
I tend to agree that if you look at the public markets, there are risks there for sure. You know, we can call it valuation bubble, etc. For sure.
We've seen risk assets be repriced. In my sense, this is a healthy correction, not something that's turning into a bear market.
Markets heavily focused on this AI dynamic. You know, are we going to get the returns on capital invested that the market expects and is priced in? It's a big debate. We're going to see the Nvidia earnings later today. That'll be a very important moment for the markets.
Wall Street executives speaking at the Bloomberg New Economy Forum saying brace for a correction. Joining us at the desk now is Ted Maloney, CEO of MFS Investment Management. MFS launched the world's first mutual fund 101 years ago and today manages more than $655 billion for clients around the world. Ted, thank you so much for joining. So obviously you have a lot of clients who will want to know the answer to what these CEOs have been saying. Are you in the same camp that what we've seen, I mean, it's not a correction so far, a fall of 3%, but it is the start of something bigger?
Well, one thing we can guarantee you is that there will be a correction someday. Markets do go up and down. They tend to go up over time. And on that point, our clients and their end clients, we're very focused with them on making sure that they stay invested through market cycles. And I think that's where you can really actually destroy a lot of value in all asset classes, is selling low and buying high. So what we want to do is make sure that our clients understand that there will be a market correction. Maybe it's just started, maybe it hasn't. There will be one day, and the key is to manage risk thoughtfully through a cycle and stay invested through cycles.
So how do you do that? How do you manage risk thoughtfully through a cycle?
Well, you think about long-term value and you think about what, in whatever asset class you're in. We're in the business of actively managed public fixed income and equity portfolios and thinking about the underlying securities, what the issuers, how durable the issuers will be through a cycle, and critically, what you're paying for them. So durability, volatility, price paid. If you carefully manage those through a cycle, you'll have good long-term risk-adjusted returns.
It's the last part that seems the most difficult, right? I mean, how do you know if valuations are too high or if we're in a whole new world?
Well, you're always in a whole new world, and the valuations always seem quite high in the beneficiaries of the whole new world. So that's a really great point, that what you don't do and what we don't do is, if we're talking about AI technology companies, we don't look at a trailing earnings multiple and say that's too expensive and walk away. We have a team of investors around the world looking at what the future is going to be, what the earnings and cash flows are going to be across the whole ecosystem, and thinking about value there. We'll get some of it wrong. We'll get more of it right than wrong. We'll manage risk around positioning and portfolio construction around that in order to deliver excellent results for our clients.
So in this part of the cycle where there are things that are, arguing for one that's more fragile, is it a problem then that, to the last conversation we had, more investors are being pushed or adding on assets that by their very nature are less transparent and less liquid in private capital?
It's not a problem big picture, and we think there are really great asset managers across every asset class. And you were just speaking to one. We admire Ares quite a bit, and they will deliver great results for their clients. As the ecosystem evolves to push private assets into parts of the investment ecosystem that haven't traditionally been invested there, we do get a little bit worried about making sure that everyone understands what they're investing, what the trade-offs are, and also what the benefits are of where they've been invested in the past. So you mentioned liquidity and transparency. We think that transparency and liquidity are features. There's a narrative out there that they're bugs, and you were just talking about it earlier, this idea that in order to stay invested through a cycle, a client needs to be locked up. We don't believe that. We believe that by working with our clients and the advisors who advise our end clients to understand the value of being long-term investors, you can be a long-term investor in the public space and then have the benefits of liquidity and transparency that you don't get in other asset classes.
So when the president talks about quarterly reporting being a problem and something we need to get rid of, you disagree?
No, we don't actually have a strong view on that one way or the other, but we don't get worried.
But you think transparency is important?
Transparency is important. The short-term nature of transparency is not necessarily helpful to investing through a cycle.
But how do you feel then, for example, private assets being in 401ks, say? Is that one of the areas that you say, okay, when things are being pushed to different aspects of this market, that worries you?
It's something that we need to make sure that the whole investment ecosystem understands what's happening when they do that. So when you talk about democratization of private assets, that sounds nice, but what it really means is putting asset classes and fee structures into structures that have served clients quite well for the long term. And when you introduce change, you introduce complexity and risk. And so we're not saying that this is going to be a major problem. We're just saying that it's important to analyze the complexity and the risk, most notably the fees, because the fees in the private space are much higher. It's one of the reasons why managers who charge those fees are looking to charge them to more end clients. When you put that into a very fee-focused marketplace like the 401k market, there will be some challenges.
Ted, what do you think about hedging in this market? Gabriela Santos was just on with us from JPMorgan and says, bonds aren't going to help unless we go into a recession. Our next guest, Bob Sloan, points out that a lot of investors are shorting the Mag 7 stocks, not because they don't like the business, but because it's the only way to hedge in this market.
Yeah. Well, we think that the index concentration in U.S. and global indices that include U.S. tech companies is dangerous in terms of its degree of concentration. So when we talk about the market correction where we started this discussion, it's almost mathematically impossible to have a market correction unless it's led by that concentrated portion of the portfolio. So you could do that by owning an index or hedging against it. We would, from a biased position, recommend that you have a portfolio professionally managed by investors that don't need to be as overweight that dangerously concentrated portion of the benchmark as the benchmark itself is. So different vehicles to get at different solutions, but yes, we would share the view that there's a dangerous level of concentration in equity markets.
Do you have a sense among your clients how much they want to be exposed to AI? There was the recent Bank of America fund manager survey that said the greatest share ever in 20 years had said that that companies were over-investing, and specifically over-investing in AI. Among your clients, is there that feeling too? Are there nerves, or is this a client base that is like, more AI exposure, please?
Well, we have a very diverse client base, and we sell through advisors who partner with end retail clients, and we partner with the largest institutions in the world. All of them want to make sure that they have exposure to the best performing long-term asset classes. And clearly AI on a trailing basis has been a major driver of that. And it's very likely to be a major driver on a long-term basis. So everyone's focused on it. It's a question that we get in almost every meeting. But the tone of the question isn't always give me all the AI you've got all the time. The tone is I want to make sure that we're driving, again, the best risk-adjusted returns for our end clients over time. And there's a lot of potential and a lot of risk in that space, and managing those complexities is what's on everyone's mind.
Are your clients maybe overexposed to the U.S. because the U.S. has been the only game in town for so long? Davide Serra at the New Economy Forum just pointing out that we've never had a time when 30% of the market is worth 70% of the valuation. Like, this is substantially higher than during the dot-com bubble burst.
Since most of our clients manage their assets against broad indices, and indices are no longer very broad and are very heavily weighted towards the U.S. and U.S. technology, yes, as an output, most of our clients are overexposed to U.S. technology. They understand that exposure. We understand that exposure. We manage the risk to it, but it is, by any historical standards, as you reference, an overexposure and a likely dangerous one over time.
Dude, what a fascinating market, right?
It
what
is.
A
It always
fascinating
is.
time to be in your job, and in ours. Ted, thanks so much for joining us. Great to have you on the program. Ted Maloney, CEO of MFS Investment Management. Let's get a quick look at what's going on in the markets on this Nvidia day. S&P 500 up 0.9%, breaking a 4-day losing streak. You can see the Nasdaq up even more as Nvidia and those tech companies gain.
All right, coming up on the show, speaking of Nvidia, S3's Bob Sloan on short interest for AI stocks ahead of Nvidia earnings. That's coming up next. You're watching Bloomberg Open Interest.
S3 Partners tracks every short and long position across thousands of funds, and their data shows something extraordinary. The Magnificent Seven now make up nearly 20% of all short positions. But S3 founder and managing partner Bob Sloan says investors aren't short because they hate mega cap tech. It's just the only way to hedge in this market. And Bob joins us now on set. Bob, I thought your data was really fascinating, and to me, a huge surprise as well. But it's not about like the ROI concern. It's just about there's no other way to hedge.
That's exactly right. So what's happened is that everybody thinks that the short interest in Nvidia, which is about $45 billion, means that people hate the company. That's not it at all. What's happened is that the Mag 7 is such a concentration of every index, and it's the biggest short interest collectively. We've never seen a market where the most owned stock is the most shorted. That's what makes this environment different. It's really different because the way you get a hedge exposure, and I think you mentioned this in your last segment, you have to short these 7 stocks. And how do you outperform? You have to go long stocks that are a little bit out there, high momentum. And so what we're seeing is, in our long data, you're seeing that the high momentum stocks are just, there's a little bit risk off, and this is causing a lot of atmospherics, a lot of tension. But it's just a risk-off trade, nothing more.
It's the kind of thing, though, when you're shorting these companies that could cause you to close your hedge fund, a la Michael Burry. Him making this announcement that the markets no longer make sense to him. He, by the way, did tell Bloomberg that he's continuing to trade just with his own and family money. But just how painful is it to try to hedge this thing? Maybe it looked good over the past week, but for the long term, it's been a very, very terrifying prospect to short these companies.
Well, but what's happened to folks is that the market structure, and every time I say that, I know the audience goes to sleep, but it's a real thing. And so what's happening is that someone like Michael Burry, what's happened? They want to short a particular Mag 7, but to hedge it, they actually go long the most shorted stocks. So there's all sorts of ways. It's like we've met the enemy and they're us. So shorting and getting that exposure to the marketplace is very, very, very difficult. And even the best, right? This guy called 2008, he had it right, got it totally wrong. It's a hard thing to do.
So how do you hedge in this market, or what, what risks would make any decent hedges stop working?
Well, that's a great question. So what would make a hedge stop working? What would make the Mag 7 not correlated to 1 to the rest of the marketplace? Well, is there a MySpace, Facebook, Meta moment? Is there a competitor out there that can displace them? Not necessarily on the horizon, right? Is there any trust to break them up? Not under this administration, right? what other factors are out there? And so people are very nervous about the circularity of some of these investments, right? Compute for investment. I think what that's actually doing is making the Mag 7 an even more important part of the index, because they're actually going to the place where they need to compete. And they're actually making it harder to displace them. So you have to short the Mag 7, right? And so you have a lot of folks out there talking about 1929, right? That's like a may I meet you moment. It's an analysis that was good 40 years ago, but has nothing to do with what's going on in the marketplace today. Nothing.
We should probably explain that Bill Ackman recently said on X that the way to meet women is to go up to them and say, may I meet you? So Bob is saying that is outdated, much like...
Right, and so what was, I'm talking about Burry, in 2008, what did he do? He shorted the AAA, and he went long the things that were not AAA. What are people doing today? What's AAA today? The Mag 7. They're shorting the Mag 7, and they're going long things that are not Mag 7. So that's why I say 1929, no, not really. That is something to keep your eye on. If the Mag 7's not correlated to 1, that's...
Can I ask one other issue that Barry points out is depreciation, right? These are things that would ruin the AI trade, as you point out. A competitor coming in, substitution risk, pricing pressure, power bottlenecks are one that everyone talks about. But no one talks about, except for Michael Burry recently, depreciation, right? These guys that used to be asset light, as Dani points out, now own all this stuff that's worth less the moment you drive it off the lot.
Right. But what's more powerful? Valuation or positioning in this market? I think he found out. Positioning, way more important. Technicals drive price action. The valuation will matter. I'm not saying it doesn't. But eventually, today, it's all about the Mag 7 concentration and whether it correlates, whether it's giving you the exposure that's one-to-one correlated with every other index.
So just to be clear, if there was some real pain, all of this just makes a fire sale more likely. Is that kind of the outcome?
No, I think what it means is that the high momentum stocks fall, because that's how people have tried to outperform.
Right.
And going long those stocks and shorting them.
But to be fair, it's had some wobbles recently. Some of those junkier things that had momentum have started to backtrack.
No, that's absolutely right.
But does that suggest that something is changing about this market and is, becoming healthier, for example?
I think Bob Diamond was on. I think he had it right. It's a pullback. You look at these things. We track what we call battleground stocks, which is where the long and shorts are basically equal. So we track what's active long versus what's active short. We're at a record number. So it's telling you people are shorting a lot of the Mag 7. That's how they're getting that exposure. And they're trying to go to these places where volatility and daily trading means a lot. And the number of those stocks has increased, almost doubled this year.
We have a skeptic writing in. A viewer points out that even though these absolute numbers may be big in terms of what's short on Nvidia, they're a tiny percent of its float, right? 1% of Nvidia's float. He's saying 1% of Google's float is short, less than 1% of Apple.
We're saying the same thing. We're agreeing. We're saying 1% of float doesn't matter. What does matter is that it's giving you exposure to the rest of the marketplace. That's what matters.
What about hedging via CDS? We've seen that recently. Oracle, CoreWeave spreads have started to widen. Is that a fruitful area that investors are looking for? Is that what we're seeing there, just hedging exposure?
Look, people are going to challenge the spending and the capex of these companies, and they're trying to find inventive ways of doing it. Maybe they don't like shorting stocks, or maybe they're not a equity investor. They are a credit investor, and they look at CDS and they say, hey, you know what? Too much money being spent. We don't believe it. Let's go buy CDS.
Bob, this has been excellent, and we'll see if those hedges pay off tonight with Nvidia earnings. That's S3's Bob Sloan. And with those earnings, don't miss an exclusive conversation. Ed Ludlow will be sitting down with Nvidia CEO Jensen Huang live at 6:30 p.m. Wall Street time. Coming up, it's a mixed bag for retailers this holiday season. We'll break down the latest earnings. That's coming up next. You're watching Bloomberg. Target and Lowe's among the retailers lowering their forecasts as people shop less and seek discounts. Bloomberg's Emily Cohn covers retail and joins us around the table. Emily, what's been your impression from the companies we've heard from today?
So what's sticking out to me today is this tale of two retailers between Target and TJ Maxx. Target, still far behind on its turnaround plan. They had to cut their guidance. TJ Maxx doing great. In many ways, I think of a trip to TJ Maxx as this like fun adventure where you find things you don't need. Many of the same reason you would go to Target back in the day. You would go for toilet paper, you'd leave with a bag and things that you didn't know you need, a pillow. Those are the things, that's the area where Target's struggling right now, and it's the area where TJ Maxx is standing out.
Does Target no longer have, remember when they had that Lily Pulitzer like collection?
No, they do like collabs all the time,
and
I feel like.
Kettle
yeah, but now it's
wanted.
like it's not with Lily Pulitzer, right?
Yeah, I guess. I remember
It's
back in the
people that
day.
you would expect at Target.
Like back in the day, they used to have like a Stella McCartney collab, which was really cool.
That's exactly where they're missing out. They're missing that pizzazz. They're missing that fun element of shopping at Target, and they don't have the value and the grocery selection that Walmart has. So it's sort of missing out on like what makes Target different. Target.
So where do they concentrate their efforts in turning around? Is it getting that spark back, or is it just let's make stuff cheaper?
I think it's both. I think you saw in the earnings today that they're definitely offering a lot of discounts this season. We'll see how that does in the holiday shopping season that kicks off next week. Also, they're focusing a lot on their in-store experience, making the store a more fun, easier to navigate place.
Interesting. What do you take from Lowe's? I mean, that is a great experience. I love going to Lowe's.
More than Home Depot?
Walking among the lumber. Actually, I don't know because, Home Depot we have in Westchester. There's not a Lowe's near me. It's the same sort of Walmart Target thing, right? I can only go to Target because there's no Walmart around here.
That is actually a really good point. I think with Target and Home Depot, another tale of two retailers where Home Depot and Lowe's are very much doing the same thing. They're trying to grow online sales. They're trying to grow their professional business. Lowe's is executing a lot better, and that's where you're seeing the growth there. And we saw yesterday Home Depot disappoint. The stock fell.
These two better executors, by the way, are not focused on the New York City, on the greater metropolitan market of New York. Why is that? I mean, I know we're talking about Target and not Walmart, but
that's true.
Why is there no Walmart amongst us in this city of like 20 million people?
I don't think they want to be here. I think they need really large footprints and really, it would be really expensive here. They don't want to do what Target did with the mini Targets. That's definitely not their priority. Their priority is building these big stores that serve as warehouses for their online delivery. That's not.
I remember when they put a Walmart in DC because I was still there at the time, and it wasn't just that Walmart didn't want to be there. People didn't want Walmart there either because they were like, it's going to bring all these people in. It's going to be too big, too crowded. We want like more mom and pop type stores.
Yeah.
Walmart's just like too big to have in a small city.
And now they can get you with e-com, right? So like one of the ways that they're really growing their business now and catering to wealthier shoppers is with e-com.
All right, very cool to get you here for a roundup. Emily Cohn covers retail, runs our retail coverage for us on the print side. Let's get a check of what's going on in the markets as we're obviously focused more on Nvidia and big tech. That's why you see the S&P up 0.5%, but the NASDAQ outperforming up 0.9%, actually giving up some of the gains that we have made in the early session.
All right, coming up on the show tomorrow, post-Nvidia earnings. We'll have Amy Wu Silverman of RBC and Kathy Bostanchik of Nationwide. Plus, we'll speak with Stonepeak CEO Mike Dorrell on infrastructure spending and just the sheer amount of capital that's being put to work to fund the AI infrastructure build out. Will Nvidia validate that thesis or call it into question? All of that coming up for the next 24 hours, including an interview with Jensen Huang, 6:30 p.m. tonight. This is Bloomberg.